Hi, my accounting folks. Today we're going to talk about Chapter 8 in your personal finance book that starts on page 198, Insuring Your Life. So, the objectives of this chapter are to explain the concept of risk and the basics of insurance underwriting, discuss the primary reasons for life insurance and identify those who need coverage, calculate how much life insurance you need, distinguish among the various types of life insurance policies and describe their advantages and disadvantages, choose the best life insurance policy for your needs at the lowest cost, and become familiar with the key features of life insurance policies. So on page 199, they talk about the basic insurance concepts. And the basic purpose of insurance is to protect you and your dependents from the financial consequences of losing assets or income when an accident, illness, or death occurs. The concept of risk. So, risk is a chance of any economic loss. There's a risk anytime you have a financial interest in something that could be life insurance, health, home, car, or your business. Risk avoidance is avoiding an act that would create risk. Example would be not driving to avoid a car accident. Risk assumption is a choice to accept and bear the risk of loss yourself. An example would be bear the cost of replacing stolen text. They talk about loss prevention and control in this chapter. So they define protection. That means to reduce chance that a loss will occur. And an example would be driving the speed limit may reduce likelihood of a car accident. Control would be to reduce severity of loss once it occurs. An example would be wearing a seatbelt can reduce effects of a car accident. And they talk about that on page 200. An insurance policy transfers your risk of loss to the insurance company. So instead of you bearing all of the risk, your insurance company would assume some of the risk. What is underwriting? Well, in underwriting basics, the insurance company decides whom to insure and the rate to be charged. The company must guard against adverse selection, a disproportionate number of bad risks. The benefits of life insurance would be financial protection for dependents, protection from creditors, tax benefits, and vehicle for savings. And they outline those benefits also on page 201. So, do you need life insurance? Always consider if your dependents count on your financial support and if you have debts like a home mortgage. You may not need life insurance if no one depends on your support and you are a child. They talk about how much life insurance is right for you on page 201, section 8.3. And they say you can determine how much life insurance you need by multiple of earnings method. So multiply your annual earnings by any arbitrary number. So that would mean at the top of page 202 in exhibit 8.1, they assess your family's total economic needs. They determine what financial resources will be available after death, and then the amount of additional life insurance required to protect your family. They also give you an example. So you can rely on the rule that your life insurance coverage should be between 5 and 10 times your current income. Thus, if you currently earn $70,000 a year using the multiple of earnings method, you need between $350,000 and $700,000 worth of life insurance. The needs analysis method estimates needs and examines available resources. And again, they give you the steps on page 202. And when you're assessing your family's total financial economical needs, you need to think about your income to maintain lifestyle, extra expenses if income producer dies, the special needs of any dependents, debt liquidation, and liquidity. You want to subtract your resources from your needs. This is the amount of life insurance needed to provide your family with desired standard of living. Then they start talking about the different types of life insurance. You have term life insurance, which is a specified amount of insurance protection for a set period. What benefit is paid if the insured dies during that time, and it is the simplest type of an insurance policy. Straight coverage remains the same while premiums can increase. A decreasing term means premiums remain the same while coverage decreases. Important features in term life insurance: renewability, so you can renew the policy without evidence of insurability, and convertibility, you can convert to whole life policy without the evidence of insurability. And they talk about this on page 206. And they show you in Exhibit 8.2, the representative annual renewable term life insurance premiums for a $100,000 policy, preferred non-smoker rates. Okay, so take a look at that table. So the advantages of term insurance is it's the economical way for young families to purchase larger amounts of life insurance, and it provides for needs that disappear over time. The disadvantages are that the premium becomes more costly as you get older, and the policy does not build cash value. Now, the difference is there's the whole life insurance policies, which do provide cash value. It provides a death protection plus a savings feature. One characteristic of a whole life insurance policy is non-forfeiture right, the right to cash value when canceled prior to death. And they show you on page 209, Exhibit 8.4, the illustration of the cash value and pure death protection in a whole life policy. They also show you on page 210, Exhibit 8.5, the representative whole life insurance premiums for a $100,000 policy, preferred non-smoker rates. And they talk about the types of whole life policies. So you have continuous premium, which is a level premium paid until death or policy cancellation. You have limited payment, which means level premiums paid for a specified number of years, insurance enforced until death. And then your single premium, your lifetime coverage purchased with a single premium. Some advantages of whole life policies are you can save on your vehicle, borrow against the cash value for things like college educations or home loans. Premiums remain constant and the cash value accumulates tax-free until it's redeemed. Disadvantages of the whole life policy are less death protection for younger people because it does build over time, low return on savings, tax penalties possible if you need an early withdrawal, and the outstanding loan is subtracted from face value policy upon death. So if you take out a loan and you borrow against the cash value, if you were to pass away, any amount you still owe on the loan would need to be paid off. They start talking about universal life insurance on the bottom of 211. This is permanent cash value insurance that combines term insurance with tax sheltered savings accounts. It provides death protection plus savings features. Premiums are unbundled into two accounts. Savings grow at current interest rate versus guaranteed minimum rate and provides flexibility in premiums paid and death benefits. On page 213 at the top, they show you the representative universal life insurance annual outlays for a $100,000 policy, preferred non-smoker rates. Make sure you check that out. And then they start getting into the different types of other life insurances. So you have your variable life insurance, which provides death protection plus a savings or cash value feature. Your cash value can be invested in mutual funds for greater possible return. And returns not guaranteed an actual death benefit can vary. They show you at the top of page 214 your representative variable life insurance values for a $100,000 policy, preferred non-smoker male, age 45. So variable life insurance combines flexibility of premium payment features of universal with investment choices offered by variable. So they talk about it in depth on page 214. They also talk about group life insurance, which usually term insurance offered through employers. Premiums usually lower than individual purchase policies, and usually the policy amounts are often lower. So usually you see between $10,000 and $50,000 and up. But most group life insurance premiums are they do not cost very much, and the amount covered is not very high. There's also credit and mortgage life insurance. So decreasing term insurance pays off outstanding balance if borrower dies before repaid, and it is a costly form of coverage. There's also the industrial life insurance, which is a whole life policy with small face value amounts, and these are generally for low income families. So when buying life insurance, you want to consider the costs and features. You want to compare those. Select a large, highly rated financial secure company and choose a reputable agent. They talk about the advantages and disadvantages of life insurance. So they talk about term versus whole versus universal life versus variable life. Okay, so you want to take all of these items into consideration when choosing what type of insurance policy you want to go with. And again, they outline this on page 215 of your text. So life insurance contract features, there is a beneficiary clause, settlement options, policy loans. They usually have a section on premium payments, what your grace period is, your non-forfeiture options, your policy reinstatement if your policy lapses, and how to change your policy. You also may have multiple indemnity clauses, disability clauses, guaranteed purchase options, suicide clause, exclusions, participation, living benefits, and viatical settlements. At the bottom of page 223, they talk about planning over a lifetime. So they give you some key considerations for life insurance use in each stage of the life cycle. They talk about the 20s, the 30 to 45 age range, 45 to 65, and then 65 and